Welcome to Module 3, Rent Economics and Valuation Principles. In investment real estate, everything begins and ends with cash flow. And at the core of that cash flow is rent. Rent is not just a payment, it's the monetization of space. It transforms square meters into financial returns. For institutional investors, rent is the input variable that determines value, drives return metrics like internal rate of return and equity multiple, and influences the asset's ability to support debt. Let's begin with the most fundamental concept. Rent is the foundation of value. Every property, from a Manhattan office tower to a suburban logistics park, derives its worth from the income it produces. That income drives the net operating income, or NOI, which is the single most important line item in any valuation model. NOI is what lenders use to underwrite mortgages. It's what investors use to model leveraged returns. It's the number upon which capitalization rates are applied to determine pricing. But rent isn't a monolith. In institutional real estate, we distinguish between several types of rent, each with distinct implications for valuation and strategy. First, there's contract rent, the rent stated in the lease. It reflects the legal agreement between landlord and tenant and is often fixed or indexed. Next is market rent, also known as estimated rental value, or ERV. This represents what the space would lease for today in current market conditions. It's critical for lease renewals, rent reviews, and repositioning strategies. Then we have effective rent, the rent net of incentives such as free rent periods or tenant improvement allowances. This is often used in discounted cash flow models to reflect true economic value. Finally, indexed or turnover rents are tied to inflation, sales performance, or revenue sharing, common in retail or hospitality sectors. These create income volatility but also upside potential. Institutional investors must understand which rent metric to use for which purpose. For example, contract rent is used to forecast cash flow. Market rent is used for underwriting releasing risk. Effective rent is used for fair valuation. Misusing one for another leads to overpricing, unrealistic IRRs, or misaligned capital deployment. Now, what determines rent levels? At a high level, rent is the price of space, determined by supply and demand, but in practice, it's far more nuanced. On the demand side, rent is influenced by GDP growth and employment levels, business confidence and sector-specific trends, tenant credit quality, location desirability, transit access, and urban dynamics. On the supply side, the key drivers are available inventory and pipeline, land use regulations, zoning constraints and permitting timelines, construction costs which affect replacement rents, macro variables like interest rates and monetary policy. As an investment banker or institutional investor, your job is to analyze these forces quantitatively. For example, in an undersupplied market with tight zoning and rising construction costs, even modest demand growth can trigger double-digit rent increases that creates cap rate compression and asset revaluation opportunities. Let's now talk about how we measure rent. Rent is typically expressed on a per square foot or per square meter basis, either annually or monthly, depending on the region. But raw figures mean little without adjustment. You must account for a lease duration. Longer leases often command discounts, tenant strength and use incentives and concessions, indexation clauses and escalation terms. Ultimately, rent reflects the utility of space to the occupier, and that utility is shaped by location, building quality, amenities, branding, and even ESG characteristics. With rent established, we move into valuation models. There are two primary methods used by institutional investors and real estate investment banks: the capitalization rate, or cap rate method, and the discounted cash flow, or DCF method. Let's start with the cap rate method. This is a snapshot valuation model. You take the property's net operating income and divide it by the market cap rate. The formula is simple. Value equals NOI divided by cap rate. For example, If a property earns $250,000 in NOI and cap rates for similar assets in that market are 5%, the asset is worth $5 million. Cap rate is the inverse of the price-to-earnings ratio in equities. A 5% cap rate implies a 20 times income multiple. The lower the cap rate, the higher the value, and the more future growth or security investors are pricing in. But cap rates aren't one size fits all. They vary by asset class, like office versus logistics versus retail, geography, tenant strength, lease duration, market liquidity, and the macro environment. Cap rates also compress in bull markets and decompress in downturns, making them highly cyclical. A compressed cap rate can make an average asset look overpriced. That's why banking analysts and buy-side underwriters use forward-looking cap rates for exit modeling. Next, we turn to the discounted cash flow, DCF method, the industry standard for institutional valuation. DCF involves projecting all future cash flows over a holding period, typically 5 to 10 years, and discounting them to present value using a required return or discount rate. Key inputs in a DCF model include base rent and contractual escalations, lease rollover schedules, releasing assumptions, and market rent growth, vacancy, downtime, operating expenses, including property taxes, maintenance and insurance capital expenditures, and reserves terminal cap rate for exit value. The resulting valuation reflects a time-weighted, risk-adjusted estimate of value, accounting for all known and forecasted variables. Investment bankers often use both models in tandem: cap rate for sanity checks and quick comps, DCF, for precision, deal structuring and sensitivity analysis. Let's walk through an example. Suppose you acquire an asset producing $250,000 in NOI. If you apply a 6% cap rate, the value is $250,000 divided by 0.06 equals $4.17 million. Now, imagine this asset is underleased relative to market rent. If you reposition it and increase NOI to $300,000 and market cap rates tighten to 5.5%, the valuation jumps to $300,000 divided by 0.055 equals $5.45 million. That's $1.3 million in upside, not from speculation, but from rental growth and market re-rating. That's the core of value-add real estate. But this model only works if your rent forecasts are reliable, and here's where many investors stumble. Common pitfalls in rent forecasting include overestimating rent growth, especially in saturated markets, ignoring vacancy and lease downtime, underestimating future capex needs, mispricing tenant credit risk, particularly in retail or hospitality, and assuming liquidity in exit markets that may not materialize. A pro forma is only as strong as its assumptions. That's why institutional investors use sensitivity analysis and scenario planning, adjusting rents, vacancy rates, and exit cap rates to assess return robustness. So, what are the key lessons? Rent is the engine of real estate value. Understanding how it's set and how it evolves is essential. Cap rates offer quick insight while DCF offers depth. Risk-adjusted return is more important than absolute rent, and most importantly, it's not about how much income you earn. It's about how resilient and recurring that income is. In the next module, we'll explore how rent becomes capitalized through finance, via leases, mortgages, and debt structuring. We'll look at how financial leverage can amplify returns or destroy them, depending on how intelligently it's used. Let's continue.